September 15th, 2008. Lehman Brothers, a 158-year-old investment bank, collapsed overnight. $619 billion in assets gone, 26,000 employees unemployed by morning. And across America, millions of people woke up to find their retirement accounts had lost half their value. Literally half. 20 years of savings, cut in half in a single day. But here's what nobody tells you about that day. While most people lost everything, a small group of investors actually made money, not just survived, profited massively. Warren Buffett made $5 billion, John Paulson made $15 billion. And millions of regular people who'd positioned their assets correctly didn't just survive the crash, they came out ahead. How? Because they understood something most people never learn. Banking crises don't destroy all wealth, they transfer it from those who hold the wrong assets to those who hold the right ones. And in the next 20 minutes, I'm going to show you exactly which assets survived every major banking crisis in history and which ones got absolutely destroyed. Because if you understand this pattern, if you know what to hold when the system breaks, you won't just survive the next crisis. You might actually profit from it. Let's begin. Let me paint you a picture of what actually happened in 2008. Not the sanitized version you heard on the news. The real numbers. The ones that changed millions of lives forever. The Dow Jones fell 53% from its peak in October 2007 to its bottom in March 2009. 53%. If you had $100,000 in a standard S&P 500 index fund, you woke up one day with $47,000. Real estate values dropped 21% nationally. But in some markets, Nevada lost 62%. Florida, 56%. Arizona, 54%. People who bought houses in 2006 were suddenly underwater, owing more on mortgages than their homes were worth. 8.7 million jobs disappeared. The unemployment rate doubled from 5% to 10%. Foreclosures hit record levels. 3.8 million homes foreclosed between 2007 and 2010. And household wealth, $11 trillion evaporated. Just gone. From $61.4 trillion to $50.4 trillion in 18 months. This wasn't a correction. This was devastation. But, and this is critical, not everything fell. Some assets actually went up. Some investors actually profited. And if you'd known which assets to hold, you could have been one of them. Let's break down what survived and what didn't. Category by category. Asset by asset, with real numbers. What got destroyed? REITs, real estate investment trusts, lost 63.77%, the worst performing asset class. Makes sense. The crisis started with real estate. REITs were ground zero. Large cap stocks fell 40.33%. These are the big, supposedly safe companies. General Electric, Citigroup, Bank of America, all crushed. Small cap stocks dropped 35.29%. International stocks fell 46.53%. Private equity lost 25.4%. If you were diversified across stocks and real estate, which is what every financial advisor recommended, you lost 40 to 60% of your wealth. Diversification didn't save you, it spread your losses. What survived? Gold. Gold gained 16.33% in 2008 while everything else collapsed. By March 2008, gold hit $1,011 per ounce, a 50% increase in 9 months. It then pulled back to around $850, but by year end, it was still up double digits. While the S&P 500 fell 37%, gold rose 25%. That's a 62% relative outperformance. If you'd moved from stocks to gold in 2007, you didn't just avoid losses. You made gains while everyone else panicked. Government bonds. U.S. Treasuries gained 19.65% in 2008. When everything fell apart, people fled to safety. And safety meant government bonds, especially during the peak panic of September and October. Managed futures gained 5.61%. These are hedge fund strategies that can profit in up or down markets. Not huge gains, but positive returns when almost everything else was negative. Certain defensive stocks actually went up. Walmart gained 20% in 2008. McDonald's rose 6%. Dollar Tree climbed 30%. Why? Because during recessions, people still need food and essentials. They just buy cheaper versions. Even Apple, a growth stock, gained 16% in 2008. Innovation can defy gravity sometimes, but that was the exception, not the rule. Now, 2008 wasn't the first banking crisis, and it won't be the last. So let's look at the pattern across multiple crises, because the pattern is what matters, not individual events. The pattern. 1994, the bond market massacre. The Fed surprised markets by raising interest rates for the first time in 5 years. Large cap stocks fell 7.75%. Small caps dropped 9.84%. What survived? Managed futures gained 4.07%. Commodities rose 3.15%. Gold stayed flat at plus 0.28%. 1998. Long-term capital management collapse. A hedge fund that employed 2 Nobel Prize winners imploded, lost $4.6 billion in 4 months, nearly took down the entire financial system. Required a Federal Reserve bailout. Stocks and REITs got crushed, but bonds gained 0.78%. Managed futures gained 5.61%. Safety assets won again, 2000. Dot-com bubble burst. The Nasdaq lost 70% from peak to trough. Large cap stocks fell 40.33%. Small caps down 35.29%. International stocks dropped 46.53%. Private equity lost 25.4%. What survived? Bonds, managed futures, commodities. Again, the same pattern. 2001, 9/11 attacks. Markets closed for 4 days. When they reopened, the Dow dropped 7% immediately. Most assets struggled, but gold gained 3.73%, the highest return of any major asset class that year. In times of existential crisis, gold shines. 2008, the big one. We already covered this. Gold up 16%, bonds up 20%, everything else down 40 to 60%. Do you see the pattern? In every banking crisis, every market panic, every systemic shock, the same assets survive, and the same assets get destroyed. So why does this pattern repeat? Why do gold and bonds survive while stocks and real estate collapse? It's not random. It's psychology and mathematics. First, understanding correlation. Correlation measures how closely 2 assets move together. A correlation of 1.0 means they move identically. A correlation of 0 means they're completely independent. A negative correlation means they move opposite directions. Stocks and real estate have positive correlation. When the economy is good, both go up. When it's bad, both go down. Owning both doesn't actually diversify risk. It concentrates it. Gold and bonds have low or negative correlation with stocks. When stocks fall, gold and bonds often rise. This is what real diversification looks like. Assets that move differently. During 2008, stocks, real estate, commodities, everything fell together. Their correlations went to 1.0. Diversification failed because everything was correlated. Except gold and government bonds. They moved opposite. They were the only true diversifiers. Second, the flight to safety. When panic hits, investors don't ask, what will make me the most money? They ask, where's my money safest? And historically, the answer has been gold and government bonds, especially U.S. treasuries. Why treasuries? Because they're backed by the U.S. government. The government can print money to pay bondholders. Default is almost impossible. So in a crisis, treasuries are considered the safest asset. Why gold? Because it's nobody's liability. It can't default. It can't be printed. It's been money for 5,000 years. When paper currencies and financial systems fail, gold remains. This psychology creates the flight to safety. Money floods out of risky assets, stocks, corporate bonds, real estate, and into safe assets, gold and government bonds. This drives risky asset prices down and safe asset prices up. The pattern repeats every crisis. Third, liquidity matters. During crises, liquidity dries up. You can't sell assets quickly without huge discounts. Real estate becomes illiquid. You can't unload a house in a week without massive price cuts. Private equity becomes illiquid. You're locked in for years, but gold? Liquid. You can sell instantly at market price. Government bonds? Extremely liquid. The treasury market is the deepest, most liquid market in the world. You can sell billions without moving the price. Liquidity is safety. During crises, liquidity is everything. Fourth, defensive versus cyclical. Some businesses are cyclical. They do well when the economy's good and poorly when it's bad. Luxury goods, travel, construction, these are cyclical. Other businesses are defensive. People need them regardless of economic conditions. Food, healthcare, utilities, these are defensive. During crises, defensive stocks outperform. Walmart, McDonald's, Dollar Tree, they don't just survive, they thrive. Because people still need to eat. They just eat cheaper. Understanding this distinction, cyclical versus defensive, helps you position for crises. Now, let's talk about what didn't work, the strategies and assets that got destroyed. Because avoiding losses is just as important as capturing gains. Diversification as commonly practiced. Every financial advisor tells you to diversify. Stocks, bonds, real estate, maybe some international exposure. Spread your risk. But in 2008, the standard diversification failed. Stocks fell 40 to 50%. Real estate fell 20 to 60%. International stocks fell 46%. Being diversified across things that all fall isn't diversification, it's spreading your losses. True diversification means owning assets with low or negative correlation, assets that move differently. Most people don't have that. They have multiple things that all fall together. Buy and hold without protection. Buy and hold works great in bull markets, but in crashes, it's devastating. If you bought the S&P 500 in 2007 and held through 2009, you lost half your money. And it took 5 years to recover. 5 years. At 0% return, while inflation eroded your purchasing power. Buy and hold assumes markets always recover quickly. Sometimes they do, sometimes they don't. Japan's stock market peaked in 1989. 35 years later, it's only recently recovered. Buy and hold works until it doesn't, and when it doesn't, the losses are catastrophic. Leverage. Leverage means borrowing money to invest. It amplifies gains, but it also amplifies losses. And in crashes, leverage destroys you. Bear Stearns was leveraged 35-1. For every $1 of capital, they had $35 of assets. A 3% decline in asset values wiped out all their capital. They went from $60 per share to $2 per share in months. Lehman Brothers, leveraged 30-1, same result. Bankruptcy. Retail investors who bought houses with 5% down in 2006, leverage of 20-1. When house prices fell 20%, they lost all their equity and then some. Underwater mortgages, foreclosures, ruined credit. Leverage works great on the way up. It's catastrophic on the way down, assuming it's different this time. In 2007, people said, real estate never goes down nationally. Wrong. It fell 21% nationally, over 60% in some markets. In 2000, people said, tech stocks only go up because the internet changes everything. Wrong. NASDAQ fell 70%. Every bubble has a narrative that justifies the prices. This time is different, but it's never different. The fundamentals always matter eventually. And when reality hits, the bubble pops violently. Assuming this time is different is how you lose everything. All right, enough history, enough theory. What do you actually do? How do you position yourself so that when the next banking crisis hits, and it will hit, you're protected? First, understand your timeline. If you're young, 20 to 40 years old, with decades until retirement, you can afford to ride out crashes. Stocks will likely recover over 20 to 30 years. Your strategy can be more aggressive. If you're older, 50 to 70, near or in retirement, you can't afford to lose half your assets and wait 5 years for recovery. Your strategy must be more defensive. Your asset allocation should match your timeline, not some generic rule. Second, true diversification, not just stocks and bonds. I mean real diversification across asset classes with low correlation. A sample allocation for someone wanting protection, 40% stocks, but include defensive stocks like consumer staples, healthcare, utilities. 20% government bonds, U.S. Treasuries and TIPS, 10% gold and precious metals, 10% commodities or commodity stocks, 10% cash or money market for liquidity and opportunities, 10% alternative investments, managed futures, hedge funds, if you have access. This isn't perfect, but it's far more diversified than the typical 60-40 stocks bonds portfolio that everyone recommends. Third, rebalance during crashes. This is counterintuitive, but it's powerful. When stocks crash and gold rises, sell some gold and buy stocks. When stocks recover and get expensive, sell stocks and buy gold and bonds. Rebalancing forces you to buy low and sell high. It's emotionally difficult. Everyone else is panicking. You're buying. Everyone else is euphoric. You're selling. But it works. Disciplined rebalancing beats buy and hold over long periods, especially through crashes. Fourth, keep liquidity. Always have cash available. 3 to 6 months of expenses minimum, preferably more. Why? Because crashes create opportunities. Stocks get cheap, real estate gets cheap, but only if you have cash to buy. And if you lose your job during the crisis, which is common, you need cash to survive, not assets you have to sell at losses. Cash, liquidity is power. During crashes, cash is king. Fifth, avoid leverage. I can't stress this enough. Don't borrow to invest. Don't max out your house purchase with 5% down. Don't buy stocks on margin. Leverage amplifies gains, but it destroys you in downturns. The math is brutal. A 50% loss requires a 100% gain to recover. Leverage makes recovery impossible. Use leverage sparingly, only if you deeply understand the risks and can afford total loss. Sixth, study defensive stocks. Even if you own stocks, own the right kind. Companies that sell necessities, food, healthcare, utilities, household products. Walmart survived 2008. McDonald's survived. Procter & Gamble survived. These companies sell things people need regardless of economic conditions. Tech stocks, luxury goods, travel companies, they get crushed. Unless you're early and can time the market, avoid cyclical stocks when trouble is brewing. Seventh, watch for warning signs. Banking crises don't come out of nowhere. There are always warning signs. Rising debt levels, asset bubbles, yield curve inversions, credit spreads widening. These indicators give you months of warning. You don't need to predict the exact day. You just need to recognize when risk is elevated and position defensively. Most people ignore the warnings because things feel good. Markets are up. Everyone's making money. Until they're not. Pay attention to the warnings. Act when you see them. Don't wait for certainty. So when is the next banking crisis? And what will it look like? I don't know the exact timing. Nobody does. But I can tell you the vulnerabilities are building. U.S. national debt is $38.7 trillion. Interest payments are over $1 trillion annually. This is unsustainable. Corporate debt is at record levels, $13.5 trillion. Much of it borrowed at low rates that are now resetting higher. Commercial real estate is in trouble. Office buildings are half empty post-COVID. Valuations are falling. Banks holding these loans are exposed. Regional banks are struggling. Silicon Valley Bank collapsed in 2023. First Republic failed. More could follow. And global geopolitical tensions are rising. U.S.-China conflict. Russia-Ukraine. Middle East instability. Any of these could trigger financial shocks. The pieces are in place. The question isn't if, it's when. And when it happens, the pattern will repeat. Stocks will fall, real estate will struggle, leverage will destroy people, and gold, bonds, defensive stocks, cash, these will be the survivors again. Because the pattern always repeats. Human psychology doesn't change. Fear and greed drive markets, and in times of fear, people flee to safety. The only question is whether you'll be positioned correctly, or whether you'll be one of the millions wondering how you lost half your wealth. Closing, 27/2030. September 15th, 2008. Lehman Brothers collapsed. $619 billion gone. 8.7 million jobs lost. 11 trillion in household wealth evaporated. But Warren Buffett made $5 billion. John Paulson made $15 billion. And regular investors who understood the pattern, who held gold, who owned defensive stocks, who kept cash, they didn't just survive, they profited. Because banking crises don't destroy all wealth. They transfer it from those holding the wrong assets to those holding the right ones. And now you know the pattern. Gold survives. Government bonds survive. Defensive stocks survive. Cash gives you opportunity. Stocks get crushed. Real estate falls. Leverage destroys. And panic selling locks in losses. The next crisis is coming. Maybe this year. Maybe in 5 years. But it's coming. The debt levels guarantee it. The vulnerabilities are building. The warning signs are flashing. And when it hits, millions of people will lose half their wealth. Again, because they didn't learn from history. Because they didn't understand the pattern. But you're different. You watch this video, you understand what survives and what doesn't. You know how to position yourself. The question is whether you'll act on this knowledge, or whether you'll keep doing what everyone else does and hope for a different result. Subscribe to this channel because the next video breaks down exactly which defensive stocks survived every crash in history. The companies that not only survived, but thrived. The stocks that made money while everything else collapsed. You need to see this. Drop a comment below. Are you positioned defensively, or are you fully invested in stocks and real estate? Be honest. Because the next crisis won't care about your intentions, only your positioning. Remember, banking crises are transfers of wealth. The pattern repeats. Gold survives, bonds survive, cash is power, everything else falls. The only question is which side of the transfer you'll be on.